All right, now let's take a look at what's happening with the banking sector in Nigeria. Now, we see the first quarter of 2023 saw the Naira redesign policy pushing Nigerians to be cashless, but the shock definitely was felt by Nigerians as most banks couldn't handle the volume of transactions on the digital channels. Cashless transactions grew by 44.84% to 126.73 trillion naira in the first quarter of 2023 from 87.49 trillion in the corresponding period of 2022. According to industry statistics from the Nigerian Interbank Settlement System, so that's what we're seeing there. But what can we expect for the banking sector in the second half of 2023? Joining me now is Mr. Silvana Seneche, Chief Risk Officer Wema Bank. Great to have you on the show.
Thank you, Ladi. Pleasure to be here.
So definitely the first half of 2023 was quite dramatic for the global banking sector, you know, with the collapse of Silicon Valley Bank, Signature Bank, you know, First Republic, and most experts say it's the interest rate hikes by, you know, central bankers globally. For you, how resilient was the banking sector in Nigeria in the first half of 2023?
Okay, thank you very much. Exactly that. The Nigerian banking sector was resilient primarily because of the regulatory environment in which we operate. So the risk management framework of the central bank, I believe, helped most Nigerian banks to weather the storm. What happened is that with the interest rate hikes, and of course, there was a loosening of regulation in the United States, and thus you saw most of the banks there taking certain decisions with regards to risk management that in a low interest rate environment seemed the right decision to make, but they had taken short-term money and invested it in very long-term instruments. And of course, when the interest rates went up and they had to mark to market, clearly they were carrying a lot of losses on their books. So in essence, the risk management framework of the regulator helped us to weather the storm. And I think Nigerian banks largely went through that period unscathed, at least with regards to the increasing interest rates. But more importantly, I think all along the line and right up to this moment, the CBN has worked along with the banks, constantly stress testing their balance sheets and ensuring that systemically the system is sound.
Talking about stress testing, how stressed were the banks in the first quarter of 2023?
Clearly, I mean, once you are in an environment where there's a lot of uncertainty, and I think you already spoke about the Naira redesign, it was a significant stress period for the banks. There was a lot of distrust from the banking public. A lot of them felt that the banks were hoarding new notes. So yes, there was a significant degree of stress. And of course, business activities slowed down prior to the election and are just beginning to pick up again. So to that extent, I will say that there was some degree of stress, but of course, working with the regulator, we sat down and all the banks, I can assure you, went through their books, ensuring that every aspect of risk that could be mitigated, that we did. And thus you see that the system came out healthy.
All right, we've seen the CBN, they've raised interest rates to about 22-year high in Nigeria, about 18.5%. How has this impacted loan, demand in Nigeria, in your opinion?
Well, there are two sides to it. The first side is, of course, with regards to discretionary items, the demand for loans has been somewhat weaker. So you would see that maybe those in the business of trading in luxury goods, they will see a dip in their sales and revenues because most people, of course, right now will only invest in purchasing essentials or what are deemed required goods. What we found is, however, that there's also been an uptick in demand with regards to people that need increasing working capital to do their business. I will give you an instance with regards to the deregulation of petroleum products. Marketers now need a significantly higher volume of credit to do the same volume of trade in terms of petroleum products that they were doing previously. So with regards to new loans, we have seen somewhat muted response, except for those that are being demanded for essential services. But with regards to existing customers, there's been an increased need for working capital. And of course, most bankers are working with their existing customers to ensure they meet that demand.
And definitely it's still all about the FX unification for most of the markets. How's this impacting the banks? And are Nigerian banks, heading for some kind of recapitalization with this unification?
Well, the FX unification, I think one of the positives is the fact that to a certain extent, it has taken out some of the opacity in terms of the allocation of foreign exchange, and also giving exporters the opportunity to sell their foreign exchange at the ruling rate and thus get market value for it. What this means for us, of course, is that there's a higher demand for quote-unquote export type businesses. And that is good because the banks are, of course, willing to fund those businesses so that they can increase their export proceeds and thus fund those customers of theirs that want to do import business. What it means also is that there's an increased need, Naira leg, to fund the same volume of imports in terms of foreign currency. But for banks, what that means is that if you can, and also your customers, if they can push that cost down to their customers, you will see them repricing their products to meet that demand. Are banks headed for recapitalization? I would say that a number of issues have come to the fore. For instance, single obligor limits in terms of loans that you are giving out in foreign currency denomination, now having repriced them or marked them to market at the ruling exchange rate, you will need to now take a second look at do you need to cut down on that limit, or are you now under pressure to increase your capital buffers to be able to do the same level of business? I would say that every bank is taking a closer look at it. Of course, a number of banks are already sensitizing the market, and I think that in the medium to long term, you will see banks raising additional capital to close down those positions.
All right, definitely artificial intelligence is quite a hype, right now, can't be ignored. How are bankers in this region warming up to AI, and what kind of disruption can we expect? Would AI impact maybe digital lending, at some point?
Indeed, you might not know it, but indeed AI has already impacted things like digital lending and even the processes in the banks. Robotic automation, for instance, you use it to do things like reconciliation, repetitive tasks that can be devolved to a robot to do rather than employing banks of people to carry out that function. So indeed, with regards to decisioning, looking at the credit worthiness of customers, as analyzing their statements of accounts which they present to make themselves eligible for credits, and also with regards to even breaking into new markets, looking at trends. Banks have thoroughly embraced artificial intelligence, and I tell you that it is already playing out in the market and it is here to stay. So Alert, for instance, which is our digital lending platform, uses significant AI to make credit decisioning.
Right. Well, I do hope AI finds me worthy of credit, going forward. Well, thank you so much. We talked to Mr. Silvanus Oneche, Chief Risk Officer, Wema Bank. It was great having your perspective today.
Thank you very much.